Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. Today, October 1, 2025, we are really diving deep into quite an information storm. We've pulled together reporting from Yahoo Finance, CNBC, Bloomberg, Reuters.
A lot going on.
Yeah, trying to tackle the big question, how are global markets handling this, perfect storm of U.S. political gridlock and these escalating trade issues?
It really is a crucial balancing act today for investors. You've got this immediate kind of painful crisis with the shutdown.
Right.
But underneath that, you still have these ongoing high-stakes policy decisions. Think aggressive new tariffs, huge corporate strategy shifts. Both are really driving what we're seeing.
And the market reaction is, it's proving pretty counterintuitive, isn't it? So you've got Dow futures down, putting a damper on that strong September finish.
Definitely.
But at the same time, gold GCF is the ticker. It just surged, a new all-time high.
And what's really fascinating, I think, is that companies aren't just, reacting passively. Some firms are actually using this chaos strategically.
Like Pfizer.
Exactly. We'll get into how Pfizer negotiated what sounds like a tough drug pricing deal, but what they got in return was invaluable policy certainty. Okay, but first, let's unpack the gridlock itself.
Okay, so reports across all the major outlets this morning. The first federal government shutdown in years kicked off early today. Senate votes failed. Neither the Republican nor the Democratic funding bill got through. Just gridlock sealed.
And this isn't just some, administrative snag. The political language around it, especially from President Trump, seems aimed at heightening the effects.
Yeah, I saw those quotes, things like, we can do things during the shutdown that are irreversible.
Right, and get rid of a lot of things that we didn't want. It turns a basic funding fight into this really high-stakes political game, almost like chicken, where blaming the other side is key.
So the immediate fallout is painful. Hundreds of thousands of federal workers just sent home.
And what makes this year maybe even worse, potentially, is that it follows that Fork in the Road program earlier this year.
Ah, right. That induced tens of thousands to leave already.
Exactly. So you already had experienced people leaving, which probably makes these operational gaps even bigger now.
Okay, but you mentioned the key insight for investors isn't just the furloughs.
No, the real danger from a market perspective is the information vacuum. CNBC's reporting that the Bureau of Labor Statistics, the BLS, it's going to completely cease operations.
Wow. Down to one employee.
Down to a single full-time employee. That's critical.
And the biggest victim of that BLS shutdown is Friday's jobs report, right? The September non-farm payrolls. Highly anticipated.
Delayed. And that puts the Federal Reserve in a really tough spot immediately.
Because they need that labor data for their meeting at the end of October.
They do. It completely clouds the outlook for their interest rate decision. They're basically flying blind on how the job market is really doing.
So if the Fed can't use the official government numbers, what are investors supposed to look at? What's left?
Well, experts talking to CNBC are suggesting, leaning much more heavily on private sector data, specifically ADP's jobs report.
The payroll processors data.
Right. But the market knows ADP isn't the same as the comprehensive BLS report. The data's just incomplete. It forces analysts to make, frankly, riskier guesses.
Okay, but just quickly, essential services, Medicare, Social Security checks, mail delivery. That all keeps going.
Yeah, those continue. The Postal Service is self-funded, and the Fed itself is largely self-funded too. So the, let's say, basic plumbing of commerce isn't stopping.
But the essential data collection has.
Okay.
Precisely. So let's look at the market's immediate reaction then. Stocks finished September strong, Dow hit a new high, but this shutdown news, it rattled things pretty fast.
It did. Dow futures dropped, 0.7% early Wednesday?
And Bloomberg noted the VIX, the volatility index, jumped too. That signals rising uncertainty, maybe fear, among traders.
But volatility and uncertainty, they often push money towards hard assets, right? And that's what we saw. Gold, GCF, hitting that new all-time high, nearly $3,895 an ounce.
And silver jumped too, about 2%.
Yeah, and this isn't just a simple, knee-jerk thing about Washington fighting.
No, exactly. I saw strategists telling CNBC the shutdown was just the straw that broke the camel's back, meaning If it wasn't this, it would have been something else causing nerves.
We really need to connect it to the bigger, maybe darker global picture, the real drivers behind this huge gold rally. It's sustained geopolitical risk.
Ongoing conflicts.
Political instability, not just here, but in Europe too, and the steady drumbeat of aggressive U.S. tariffs. All these things are piling up.
Creating a picture where holding cash feels riskier than holding gold.
That seems to be the calculation. The instability makes physical assets look, well, safer.
And the bullish calls are pretty stunning. Analysts at places like BNP, Paribas Fortis, UBS, they're talking $4,000 gold. That feels like a headline from the future.
It does, and they're arguing that $4,000 might not even be the end point.
Why? What's the argument?
The structural argument is what's interesting. They say gold makes up barely 2% of the average investment portfolio worldwide right now.
So it's underowned.
Structurally underowned is the argument. It suggests there's huge potential for more institutional buying, especially as these geopolitical risks basically force more strategic diversification into hard assets.
So moving from speculation to strategic allocation.
Exactly. UBS thinks the bull run continues precisely because investors are starting to see gold as a core holding, not just a trade.
Okay, so if the big picture is chaos driving gold, how are individual companies navigating this? Let's pivot to corporate strategy. That Pfizer deal you mentioned, Bloomberg and CNBC reported on it.
Right. Pfizer basically secured this massive 3-year exemption from threatened pharmaceutical tariffs. That's huge certainty in a world lacking it.
Okay, wait. It sounds good, but didn't it come at a massive cost?
Yeah.
I read they agreed to slash U.S. drug prices, some up to 85%, average 50%, and sell directly through a site called Trump RX, and launch new drugs at parity with other countries.
Yes, the price concessions were significant, no doubt about it.
So is giving up potentially 85% margin really a win? Or just picking the least bad option?
That's the key question. Analysts, like at BMO Capital Markets, framed it as a strategic victory, basically buying out political risk.
Trading margin for certainty.
Exactly. They traded profit margin for 3 solid years of policy stability, potentially avoiding much worse, like industry-wide tariffs or pricing mandates. And the market seemed to agree.
That was so.
The S&P 500 Pharmaceuticals Index climbed 3.8% on the news. And Bloomberg's reporting, Eli Lilly, Novo Nordisk, they're already in talks for similar deals.
Suggesting this might become the playbook for the whole sector.
It looks like it. Negotiate certainty even if it costs margin up front.
Fascinating trade-off. Okay, so on the other side, let's look at Nike, NKE. They're facing tariffs directly in manufacturing, right?
Right. Nike actually beat Q1 revenue expectations, which is good. But the warning came in their future guidance.
What did they say?
Their CFO projected the tariff hit for fiscal 2026 could be around $1.5 billion.
Wow, that's up in the $1 billion they projected just last quarter.
It is. And that jump seems to reflect these really aggressive tariff hikes on specific countries they source from.
Yahoo Finance mentioned Vietnam going up to 46%, Cambodia, Indonesia both at 19%.
Yeah, those specific hikes are biting hard. So Nike's strategy is purely about mitigation now.
Meaning?
They're actively trying to reduce how much they rely on China for goods sold in the U.S., and they mentioned implementing, quote, surgical price increases in the U.S. this fall.
Trying to pass on the cost carefully.
Trying to pass it on without killing demand. It shows how this policy volatility forces really rapid and probably expensive changes to supply chains.
And looking ahead, Yahoo Finance reminds us President Trump promised new duties starting this week. 25% on heavy trucks, duties on timber, lumber, movies, furniture.
So this isn't slowing down. If anything, the policy volatility is accelerating.
Okay, let's shift focus globally for a moment.
Yeah.
Asian markets were mixed overnight.
Yeah, Japan's Nikkei 225 slipped. The Tankin Business Sentiment Index, which measures manufacturer optimism, came in at plus 14.
Which was lower than expected.
Just slightly below the plus 15 economists polled by Reuters were looking for, according to CNBC.
And India.
The Reserve Bank of India, the RBI, held interest rates steady at 5.5%. That was unanimous and pretty much expected.
Any reason given?
The governor basically said the effects of their last rate cut 50 basis points back in June haven't fully worked through the economy yet. Their main focus is still boosting domestic consumption.
Especially with those U.S. tariffs hitting Indian exports like textiles and jewelry.
Exactly. That puts more pressure on their domestic economy.
Okay, also tracking that trend of companies moving listings away from London. AstraZeneca, AZN.
Right. CNBC reported they plan to delist their ADR's American Depository Receipts from the NASDAQ.
And replace them how?
With a direct listing of their ordinary shares on the New York Stock Exchange, the NYSE.
Why the change?
It's a big structural move. ASEAN stress it doesn't change their UK home base or taxes. It's really about attracting a wider range of global investors.
And potentially making it easier to get into the S&P 500 index.
That seems to be a key motivation. S&P 500 inclusion opens up access to massive pools of institutional money that track the index.
Makes sense. Okay, couple of big corporate movers making headlines too. Berkshire Hathaway, BRKB.
Yeah, reports are they're getting close to a $10 billion deal, buying Occidental Petroleum's OxyChem unit.
That'd be a big one for Buffett's firm.
If it closes, CNBC says it would be their largest deal since 2022.
And on the sort of national security strategic materials front, the U.S. government took a stake in Lithium Americas.
Yes, a 5% equity stake, according to Yahoo Finance. That's a pretty significant step towards securing domestic lithium supplies for U.S. battery production.
Critical minerals, critical supply chains.
Exactly. Ensuring stability there is becoming a national priority.
And we have to briefly mention Palantir.
Sure.
Oh, wow. CNBC reports the stock's up over 1,700% since its debut in 2020.
It's been a staggering run. Market cap over $432 billion now.
Driven mainly by government contracts and the buzz around their AI platform, AIP.
Largely, yes. That platform helps clients integrate things like large language models securely, which is obviously huge right now.
Okay, so let's try to tie this all together. What's the big picture takeaway from today?
Well, if we connect the dots, I think the main risk from this U.S. shutdown isn't just the immediate operational cost. It's really the information vacuum it creates.
Forcing the Fed and investors to guess about the labor market.
Exactly. Flying blind.
Right.
And that lack of certainty, combined with the geopolitical mess and the tariff escalations, that's precisely why safe havens like gold are becoming more structural.
Less speculative, more core holding.
Right. It's gaining importance in portfolios globally for strategic reasons now.
So what does this mean for you, the listener, managing your own portfolio? I guess in a world with this much policy volatility, these serious data gaps, the key takeaway seems to be volatility probably demands some diversification into hard assets. And watching companies based on their geopolitical strategy seems crucial.
Whether that means negotiating costly certainty, like Pfizer did,
Or aggressively managing tariff risks, like Nike is trying to do. Corporate success really hinges on navigating that policy landscape now. Okay, final provocative thought to leave you with. This move by the U.S. government, taking equity stakes in companies like Lithium Americas, is that just a temporary fix for supply chains?
Or could it signal a more permanent structural shift towards government-backed industrial policy, especially in sectors deemed critical for national security?
Something to definitely think about. What does that imply long term?
Indeed.
We'll see you all tomorrow morning with new headlines from major financial magazines.